Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we're reflecting on recent moves by the US Federal Reserve to cut interest rates for the first time since March 2020. We'll ask our panellists from UBS Global Wealth Management for their reaction to the 50 basis point reduction. We'll look at the macro picture and we'll delve in more detail into what this week's moves could and should mean for savvy investors. We start with our good friend Paul Donovan, Chief Economist in UBS Global Wealth Management. Paul, always a pleasure to welcome you. Give us your reaction, if you will, Paul, to Wednesday's 50 basis point cut from the Fed. It was very much within the bounds of expectations, I think it's fair to say. But what did you make of the announcement itself and what Fed Chair Powell had to say about it?
I think we had a rather peculiar situation. So the overwhelming majority of economists were looking for a quarter-point cut because they're saying, there's nothing particularly wrong with the US economy. Traders who get a little bit more excited about such things were more inclined to look for half a point cut. And of course, that's what we got. It is a bit peculiar, though, because half-point rate cuts are normally conducted when there's an economic emergency. And there's no economic emergency in the United States at the moment. You are operating pretty much at full employment. You've got rising real wage growth. Inflation is under control. Consumer spending is perfectly adequate. So in that sense, it was very, very surprising that the Fed felt the need to cut by 50. Now, the Fed has been late in cutting rates. They should have been cutting back in May of this year. They have been late. And so there was always this sense they were going to scramble to catch up. But I think most economists were looking for them to cut every meeting this year at a quarter point a time, rather than sort of rush out with a big cut to start off with, which is obviously what we ended up with. The other thing that was interesting in the decision, of course, was there was a dissent. Now, dissents at the Federal Reserve are generally supposed to be all part of the messaging. So it's always a little bit hard to know whether people are actually genuinely dissenting or whether this is part of the messaging. This was the first Fed governor to dissent in 19 years. And they were saying, actually, you know what, it shouldn't be half a point, we only need a quarter point. And what I think that has helped to do is to create this notion that the economy isn't in serious trouble, that quarter point was an option, but they felt they'd go for a half a point anyway. So they're trying to make sure that there's no sense of a crisis in the economy when, obviously there isn't. And they've just gone a little bit more with the rate cut as they scramble to catch up and, repair the damage of not having cut when they should have done back in May of this year.
Well, yeah, Paul, and so give us a bit of an overview then, because I guess, look, this is some pretty aggressive action, but I would say broadly, if you look at how inflation is now tracking below those highs we saw, a couple of summers ago, without a recession, things are kind of going fairly well. The central bank's done a pretty good job. Do you think that is the prevailing view? Because it was instructive, wasn't it, that Fed Chair Powell went out of his way to say, we're not behind the curve when people put that to him in the presser on Wednesday.
Yes, and I think the famous quote is, of course, he would say that, wouldn't he? He can't admit to being behind the curve because that would admit to his incompetence as a Fed chair. Now, I think they are behind the curve, and I'm not a huge fan of Powell as Fed chair. I think he's not had a good chairmanship. I think part of the shift that we're seeing in inflation, of course, this would have happened anyway. So the Fed will obviously try and take credit. We brought inflation under control. But they didn't really. I mean, most of the reduction in inflation was just naturally going to occur. Transitory inflation was transitory. Oil prices don't stay high forever. All this sort of thing was naturally going to reverse and did. But with that reversal, with that decline in inflation, the Fed does need to follow inflation lower. And that is one of the reasons why I think the Fed has been behind the curve and why they're now having to scramble to catch up. When you look at the genuine cost of living, that has come down quite a way in the United States. Inflation pressures away from the nonsense of housing measures, which actually the Fed has pushed up as a general rule. If we look at the broader economy, the disinflation forces have been very marked for a very long time now. The medium-term trend of inflation has been very obvious to economists for several months. And so the Fed, like other central banks, is following inflation lower. They were just taking longer to get started in that process.
Paul, let me ask you to look ahead for us, because another thing I thought was interesting was hearing from officials from the Fed was that more rate cuts to follow. And if we go back, even I think as late as, midsummer of this year, the suggestion, at least from some of those same officials, was for one cut in 24. It now looks like there'll be, I don't know, another quarter point cut at each meeting? What's the expectation? And do you think that the fine detail of that is super important, or do we sort of overweight importance actually because we just need to look more significantly at the general kind of direction of travel?
So I think we do need to look at the general direction of travel and how quickly is the Fed going to go back to a more neutral rate. Like I said, they are behind the curve. They do have to catch up with the declines in inflation. I think the shift has been caused by perhaps some of the outlying views of Federal Reserve members being corrected by the fact that it is very obvious that inflation was coming down. And this has been one of the real criticisms of the Powell Fed, is this stress on data dependency from Powell himself and others, which is very, very backward looking. And of course, the problem is that monetary policy is forward-looking, not backward-looking. Monetary policy takes a while to filter through into the economy, and typically 12 to 18 months before it has full effect. So when you've got this situation where Powell is saying, no, we're data dependent, we're looking at the very last data release, that can create this sort of sudden shift, because as the data starts to show declining inflation pressures, you suddenly realize, oh my goodness, we need to cut rates and it's not going to affect the economy for another year. That's when you get this swing in opinion, which is what we seem to be seeing from some members of the Fed, at least. The other thing, of course, with data dependency, because data is less reliable, it's a lot more volatile. We're getting big swings in numbers. We saw that with the employment data in the States over the summer, where you get a real anomaly in the July employment report, which then totally recovers in the August employment data. But that sort of swing backwards and forwards also, I think, has shifted opinions about the need to move. But obviously, because the data itself is volatile, that means that opinions on policy will also be volatile.
Well, from policy to politics, Paul, let me just ask you briefly about the political optics here, because, again, Powell is always at pains to remind people listening to his remarks that the Fed is an apolitical body and it's making decisions in the best interests of Americans and the American economy. But it's very difficult to look at this cut. What are we, 6 weeks out from this very consequential general election? Again, is it unhelpful even to sort of mention politics and the politicization of these decisions? Or is it just sort of, I don't know, I find it interesting, but is it unhelpful?
Well, obviously politicians are seizing on this, and former President Trump came out and said, well, this just proves the economy's in a terrible way, which it doesn't. And the Biden administration was coming out and saying, we've tamed inflation and so on and so forth. And of course, both sides are claiming things which are not necessarily either to their credit or true. If we're thinking about the real politics of this, what we have to remember is that people in the real world think about economics as they perceive it affecting them. They don't necessarily pay much attention to the numbers. So this is why, and we've discussed this in the past, this is why food prices matter a whole lot more to people's perception of inflation, because then the abstract number of consumer price inflation doesn't necessarily apply to them. Things like an interest rate cut, for some people, that will have a direct, immediate impact. If you have got an overdraft, to some extent, if you've got credit card debt, you may notice this, although with credit card debt, the interest rates are so high anyway that a half-point cut doesn't make a great deal of difference. But actually, for most Americans, when they're sitting down and thinking about how much money have they got at the end of the month, this decision of itself doesn't make a great deal of difference. And so to that extent, the political ramifications of this, it's not changing people's lives, not yet. As I said, policy operates with a lag. It might change your economic circumstances 12, 18 months down the line. Is it going to change your economic circumstances between now and the time you mail in your ballot or you go and vote in your local voting booth? Probably it's not going to make that much difference.
Paul Donovan. Well, next up, let's get another perspective as we turn to another good friend of and regular voice on this programme, Kiran Ganesh, Managing Director in the UBS CIO. Kiran, welcome back to the show. We'll come to the investment implications in a second, but just to kick off, well, I asked Paul for his reactions to Wednesday's move. What was your kind of initial response? It's a pretty aggressive rate cut, wasn't it? 50 basis points. Was that in line with your expectations? What was your reaction?
Yes, well, the move was actually in line with our expectations, but it is nonetheless a big move to start the rate cutting cycle with a 50 basis point cut. I think it's worth remembering that the Fed has been a bit of a latecomer to the easing cycle, which is now taking place across the world. We've already seen rate cuts in Europe, in the UK, in Switzerland. So the Fed a little bit later to the rate cutting party, and maybe that's part of why they felt they had the scope to cut rates by 50 basis points up front. We have seen inflation falling quite sharply in the US. We've seen some signs that the labor market is slowing down. So I think the Fed wanting to show that they're there and ready to support the market. They don't want to be holding rates too high for too long, but they also signal that they are going to remain focused on the data, and then their future decisions will depend on how the economy and how inflation develop.
Kiran, let's talk about the impact of the cut next. For companies, is it the case that, this will provide a fillip, particularly obviously stateside, for companies, cheaper debt will be available more quickly? Does that mean there's reinvestment opportunities? Is that another boost then potentially to stocks? What do you expect to see happening as a result of this?
Well, at the margin, lower interest rates should make it cheaper to borrow, and they don't make it as profitable to save. So the idea is that you'll start to see more investment and less saving, and that should boost economic growth, and all else equal would also mean slightly higher inflation. So that's the theory. I think it will be very interesting to see what happens this time, because a trend that we have seen in the US economy over recent years has been that the maturity of debt that companies have been taking out and households have been taking out in their mortgages has been quite long. So one interesting trend that's happened recently is that even though the Fed increased interest rates quite a lot, it didn't have that much impact on consumers or on businesses, because in many cases they'd taken out 10, 20, 30-year loans prior to the interest rate hike, so they weren't really that affected. So on the flip side, now they're cutting interest rates. It will be interesting to see, to what extent that does have a big positive impact on economic growth, because the hikes themselves didn't have a particularly negative impact on the way up either. So that'll be certainly an interesting trend to watch out for. One area where it could have quite a positive impact is on home building, because certainly one trend that we had seen was that people were unwilling to move homes, because if they moved homes, then they would have to refinance their mortgages at higher interest rates. Now, if interest rates start to come down, that might start to unlock some of that willingness for people to move homes. And then that should, kickstart things like home building and related industries that tend to do well when people move homes. So people move home and they tend to start renovating or maybe buy a new car and this kind of thing. So that's one area where we would expect to see a bit more impact from the lower interest rates around that house moving aspect of the economy.
So, Kiran, look, so much interesting background, and it is so intriguing to consider what the implications are. Let's talk then about the investment impact, portfolio construction, decision-making. I don't know, how does that trickle down? And in terms of the advice that you and your colleagues are going to give to clients, what does that start to look like as we begin to factor in this decision-making into actual investment decisions?
Yes, we broadly say three things are important to think about for investors right now. So one is that cash rates are falling, and the Fed has indicated that they're going to keep falling going forward. So it's been relatively easy to earn income over the past couple of years because cash interest rates have been high, and that period is coming to an end. So we're discussing with clients how they can invest cash in things like medium duration fixed income, diversified fixed income funds, which have more durable income in our view than cash, where rates are going to fall. So I think that's one area. A second is on equities themselves. Historically, if the Fed has cut interest rates and the economy has not had a recession, that's a very positive environment for equities. So we've seen mid-teens growth on average on an annualized basis when we've had that kind of environment. Now, that's our base case, no recession and the Fed cutting interest rates. And so we think that this should be a good time for equities. We're emphasizing a focus on quality companies because there is still some uncertainty in the economy, but we think that companies with strong balance sheets and a track record of growing earnings, even during downturns, we think should be quite well positioned, even if we do get a recession, even though our base case is that we don't. So, looking for those quality equities. And then the third area is in the currency markets. If we look forward, we think that the Fed is going to be cutting interest rates by more than most of the other central banks in the world. And so we think that the dollar is going to weaken. So for people who've got exposure to dollar assets, and particularly dollar cash or dollar fixed income, then we're recommending switching some of that or hedging some of that into other currencies, including the British pound, the euro, the Australian dollar, and the Swiss franc, where we think they're going to appreciate because interest rate cuts in those regions are not going to be as deep as in the US. So yeah, just a few ideas from an investment perspective on how to respond to the Fed.
Kiran, Ganesh, and before that, Paul Donovan, bringing us to the end of this edition of the Bulletin with UBS here on Monocle Radio. You can listen again and explore more at monocle.com. That's where you can join the club and subscribe to Monocle magazine. You can also follow this programme wherever you get your podcasts. And don't forget, if you'd like to discover more and to find out how UBS can help you, head over to ubs.com. I'm Tom Edwards. Thanks for listening.